Second quarter earnings season really shifting into high gear with big banks reporting this week. But unlike Dick Beauvais, who says the actual earnings number may not matter that much, Christian Thwaites of Sentinel Investment, he says, look, it's all about earnings, and he joins us now. Christian, good to have you with us. Thanks for coming in.
Thank you very much.
You say really you've got to look at the details of what the companies earn, right? I mean, we want to find out what's going to happen in the second quarter.
Yes, I think we're in a market where earnings is going to be everything. I mean, we've had a market so far this year that's been politically driven, economically driven. We've had every acronym under the sun drive the markets. We've had a lot of sentiment. We've had the huge down cave and then the upside from 40%. But now it's about what CEOs and CFOs and purchasing managers are going to say about the second quarter earnings and their forecast for the rest of the year. And I think that's going to eliminate a lot of noise from the market. But it's
so the
going to be
pundits kind of have to be quiet for a while, and everyone just actually look at the details when those quarterly statements come.
Yeah, let them describe what the customers are seeing. You know, what prices are doing, what order books are doing. And there's some key earnings coming up this week and next week. I mean, the financial is not really an interesting story at this point, but
why? Because you think they're going to all outperform estimates?
Oh, sure. I mean, the Goldman Sachs story is about the fixed income currencies, commodity trading, proprietary trading business, and there's about $80 billion of equity secondary offerings in the second quarter. They'll be underwriting that at about 3 to 4%. So there's some easy earnings to be had, but it's the Caterpillars and the Nokias and the IBMs,
the global economy.
Exactly. The guys who really have a good footprint, not only in developed markets, Western Europe, United States, but also Latin America and BRIC. These are the guys that I'm interested in hearing what they're saying about prices and order books and volumes.
Are you at all concerned that the market is retracing from all of those high beta stocks? Everyone looked like they were getting into the risky side of the market to perhaps capture some of that upside, and now where are we headed?
I think it was a very momentum-driven trade, and it was really it was a fear about inflation, and commodities took off. The bond market got spooked. We saw the 10-year go up from about 3.1 to touching 4%. But now I think we're sort of more in the deflationary trade mode, where the bond market has come back quite a bit. It's nice rally there. Commodities have come off the boil a little bit, and I think in equities we're going to see a retracement back to good defensive, good defensive earners, and it'll be a stock pickers market.
All right, well, let's pick some stocks then. Let's talk about some of the ones,
sure,
at least that you've been following for a while, because one of the criteria you say is, look, they've got to have a good balance sheet and they've got to have some decent cash, right? Talk about Teradata. Why a Teradata, for example, right now?
Well, Teradata's story is it's one of the cheapest stocks in its sector, in the technology sector, and it's a spin-off from NCR a few years ago. And it sounds, when you first describe it, as pretty mundane business. It's data warehousing, enterprise data, analytical services. But we
don't mind mundane as long as it's going to be profitable, right?
Huge amounts of cash flow, good balance sheet, 55% margins. And listen, any company these days which gets a 35% return on its equity, so that's 5 times the risk-free rate. I mean,
we're trading about 18 on a forward PE basis?
Oh, less than that. It's more like about we measure on a free cash flow, about 12, and it's a relatively high tax rate because it's got very little debt on the balance sheet. But the interesting thing about this company is it has some of the bluest chip customers out there. To Verizon, CVS, Apple, the IRS. The government's a good payer, among other things. But they really have a value added on their sort of ability to strip into data and provide real-time data management to these companies. So they can literally be part of the retail chain management process.
Now, once they get a customer, for example, is that what they just like to say is a sticky relationship?
Very sticky.
You get that customer, they're not going anywhere for a while.
Very, and they add a lot of value-added services as well. So their biggest competitor is clearly going to be Oracle with the X-Data product. But these guys know their customers very well, and their ability to have really high-powered analytics behind their product, I think, gives them a real edge. So we like that.
Do you ever wonder, though, that IT budgets, are they going to come down? Are people going to start to say, you know what, you can't show me any return on invested capital here in an IT program, so we're just going to wait and see what happens with the economy, with the earnings, before we make any big commitments?
Yeah, but this is not really a traditional IT capital expenditure play. This is about sort of getting right into the core of their customers' business. So that's what we like about it, the fact that they're in the retail, the whole sort of demand chain management process, so they can see when inventory is moving, where it's going, who's buying it. And you're not talking about on a weekly or an aggregated basis. You're talking about real time. They're literally able to help their customers move product from one store to another if they're in retail, and provide very, very high-powered analytics. And so the clients are sticky, and the value-added services are very high.
So when you turn on the lights in the store, you're also turning on a Teradata system.
Exactly. You're putting money into Teradata's products. SAP and IBM, you know them, they're big sort of enterprise software companies. They like this space a lot. Teradata's been there longer, and it knows its customers very well.
What about someone taking them over?
Well, that's the other thing. It's not that widely followed on the market. It's about a $4 billion market cap. It's had a nice rally. But it's still basically under followed. So
up about 60% so far this year.
Yeah. It's risen with the tech sector.
So would you commit some new capital right now?
I would.
Or you want to see we want to see what happens in the second quarter?
Well, I wouldn't mind. I don't think you'll see a big swing in the second quarter. I think that customers are still going to pay on time. We've seen other, like WebSense last week. We've seen where customers have pulled back from paying, but these customers are fully integrated into their system and businesses.
All right, well, you've got to mark your calendar. August 6th, I believe, is when they're coming out with their earnings. That's before the market opens, Teradata. We're going to continue the conversation more with Christian Thwaites of Sentinel. We're going to find out what other companies he likes and what are the characteristics. One of them an international player and one a small medical device company. We'll find out where he's allocating capital. This is Taking Stock on Bloomberg. This is Taking Stock on Bloomberg. I'm Pim Fox. My guest, Christian Thwaites. He runs Sentinel Investments. As we head into earnings season, he says focus on corporate balance sheets, focus on corporate earnings. Christian, one of the other companies you wanted to talk about is Honeywell. I just had David Winters on. He was talking about Schindler.
Yep.
I want to correct myself, based in Switzerland. He said that is, a global play on infrastructure, elevators. Honeywell, a lot of global products.
Yeah, so Honeywell, as you know, is a great blue chip company based out of Minneapolis. Has been a Dow 30 member for years and years. It's been held back this year as industrials have generally not performed as well as the rest of the market. But the industrials is so overweighted by GE. And the story at Honeywell basically is it's into aerospace, auto controls, specialty chemicals, sensors. So it's really a play on global infrastructure, increased urbanization, so it has a nice exposure to third world markets. We like that.
Acquisitions,
Smart systems.
though. I mean, I got to just stop. I mean, they've made a lot of acquisitions.
Yeah.
Was that what the investor community has been a little bit skeptical about, whether those investments are going to pay off?
Definitely. I mean, they've been on the acquisition trail sort of off and on, and they've never seemed to integrate very well, and they have tended to buy at peaks. But the underlying businesses are very, very strong, and the franchise of the company is very good. And I think what we particularly like is the kind of smart system side of it. I mean, if there's one thing that's going to come clear out of any White House bill or any sort of global trend, it's the ability for energy savings in just everyday office climate control buildings.
Climate control, smart grid systems.
Smart grid systems. They also have as you know, anyone who flies in the United States just knows how log-jammed and clogged the arteries of the U.S. airway system is. They have smart landing systems which are being introduced in more and more airports, which sort of ease that control up. So, and again, the other thing that we like about Honeywell is long-term contracts. They put in the initial systems, and then there's ongoing revenues to sustain them and keep them up to date and keep them in place. So that good visibility of earnings. All
right, good visibility of earnings. We've got to wait until the 27th of July to get those details. Forward PE ratio right now of about 10.
Yeah, I mean, it's outstanding. I mean, it's that could trade high as mid-teens. But again, what we like about this is almost the same number as we talked about with Teradata. It's a 34% ROE. So here's a major corporation, 22 billion market cap, able to get a 34% return on its equities without leverage. I mean, it's a phenomenal testament to management. Now, if you're getting 34% ROE, eventually that's going to come through to the investor in the form of capital gains and dividends. So that's a good long-term hold. No reason to rush into it, And there'll be some weaknesses over the summer, I'm sure, but a great long-term holding.
All right, let me switch now. Let me go to the other end, because we're going to talk about a small cap medical device company. This is American Medical Systems. We talked about Teradata, talked about Honeywell. What is it about medical devices right now?
Well, it's medical devices, but American Medical Systems is really sort of the #1 in urology and prostate, and their devices have very high margins. They're really #1 in pelvic health. And there's an interesting statistic that more women in a given year will have a hysterectomy than will graduate from U.S. colleges. I mean, it's a booming business, and it's not operations and procedures which people tend to put off. In other words, if they need them, they tend to get them, either with reimbursement or partial reimbursement. So
perhaps not affected by as much healthcare reform uncertainty.
Or even economic indicators.
All right.
And they're also in the minimally invasive side of things, which, that helps recovery rates. It means procedures can be more quickly turned around. It helps the productivity of the hospitals. They absorbed a firm a few years ago. They got a new CEO. It's a good trend, good things going on.
All right, I want to thank you very much. Christian Thwaites coming in from Sentinel Investments, sharing your thoughts about some companies and focusing on corporate earnings.